Good morning, good afternoon, good evening. How are you doing? I hope you're doing well. Welcome into the channel. If your first time stopping by, I appreciate you doing so. Tonight we're going to recap what happened at Jackson Hole that caused the market to pull back 3.38% in one single day. So on Friday, we had Jackson Hole. If you're not familiar with Jackson Hole, it is when Fed Jay Powell talks about their next course of action. Now, if you are newer to the market or you're not familiar with who the Fed Reserve is, the Fed Reserve, they set the principle and they set the policy for monetary policy. Basically, how cheap or how expensive it is to borrow money, and if we are going to be pushing money into the market to sustain operations, or we're going to be pulling money out of the market to tighten up the cycles because we have overinflated. At this point in time, we are in the quantitative tightening cycle where they're pulling money out of the market to allow us to rebuild the safety net that we need in case we go through another crash. So think back to March of 2020. You realize that COVID happened and there was a massive COVID crash where the market dumped about 30%. Given that, we were able to rebound in 2020 and 2021 over 75% from the lows. Why was that? Because the Fed had created a safety net where they could drop interest rates, send their policy into quantitative easing, which then allowed the market to sustain a move back up, allowed businesses the opportunity to reinstate hiring and not close their doors. Now we've gotten to a point where we pumped a lot of money into the cycle and into the market. We also put relief checks into, or stimulus checks into the hands of Americans. All of this, alongside supply chain issues and many other factors, caused an elevated inflationary period, which is where we find ourselves today. We are in an inflationary period, and a few months ago we were running around the 9% time period or framework for inflation. Now, the Fed's policy is to sit around the 2% mark for inflation. So you can see we were over 4 times what they projected. So the way to control inflation and to mitigate inflation is to go through a quantitative tightening cycle where they have to drain some liquidity from the market to then allow inflation to come down. And that is where we find ourselves at the current moment in August of 2022. The market has moved down absolutely exponentially since January, given the fact that we are in a tightening cycle. Now, with all that being said, why did the market move down almost 3.5% in one single day? That's the Jay Powell crash right there, just because of what he said at Jackson Hole. So we're going to break that down today, and we're going to talk about the impacts of what he said. So like I mentioned, the goal for the Fed is to get at 2%. We are sitting around 8.6% at the current moment, so we're still relatively high in terms of the inflationary goal. So what Jay Powell said is, hey, we are going to have to inflict more pain on the market to be able to control inflation because it's not coming down as quickly as we anticipated based on our tightening cycle. Within a tightening cycle, they raise interest rates and sometimes they even run off assets to their balance sheet. Both of those things are an aggressive stance within a tightening cycle, and we're seeing both of those play out today. So Jay Powell reiterated, hey, we are going to continue down that cycle and we are going to have to inflict more pain on the market given the fact that we are not seeing inflation slow down to 2% as we expected it to happen. So he said, expect more pain. He said, we're likely going to see below average growth and a softening labor market in effect of what is happening within the cycle. So that just means that the market itself is expecting more pain ahead, just as Jay Powell said. Now, the market over the past month or so has fueled a nice move up off of a few different things. First, we had really strong earnings. Second, there's the potential that the Fed was going to pivot because inflation started to soften. It started to roll over. But Jay Powell reiterated, no, we are going to continue to remain aggressive. We're going to continue to push after controlling inflation. And so he said, expect more pain. And the way that they're going to do that is continue to raise interest rates, roll off assets to their balance sheet, and then they are going to slow growth. Now, some companies are already reacting to this, and they have already put in hiring freezes. They have already slowed down any of their advancements within new hires, any operations. They've kind of put pauses on those projects and things like that. So we've seen even like Apple say, hey, we're not going to be reinstating a lot of our recruiters. We've seen companies like Microsoft and Google say, hey, our hiring is going to be slowing, or we're going to have to see some layoffs. Shopify mentioned it as well within their earnings report. Same thing with Walmart. All of these companies were anticipating a continued tightening cycle that puts pressure on businesses to perform and instate a profit. Those companies that are showing a profit have the cash available to withstand this tightening cycle and the softening labor market. Those that are unprofitable businesses have been getting absolutely hammered over the past few months, given the fact that we have a tightening cycle and they're not making money. So it's going to be a lot harder for them to make money and fuel their growth. So they've gotten hit relatively hard. But big businesses that are doing well, such as Apple and Walmart, they're starting to feel the effects of it as well. Okay? So Fed Jay Powell said, hey, it's not going to get any better. We're going to actually have to make it worse before it gets better. So the way we're going to do that, we're going to see higher interest rates over the next few months. We're going to have to remain aggressive. We're going to still have to push for 50, 75 basis point rate hikes to try and slow this inflation. So we are going to see more restrictive policy than we originally anticipated because inflation's not coming down in the way that we expected it. If we look back at history, in the 1970s, we actually loosened a little bit too soon. And in the 1970s, this loosening of policy actually came back to hurt us. So Fed Jay Powell's trying to take a different stance and say, hey, we're going to attack, and we're going to attack hard because we want to bring short-term pain for some longer-term gain within the market. And I think personally, this is the right approach. Even if it causes a big recession within the next few months, maybe the next year, it's going to allow for us to reset the economy, get us back into a nice growth potential, and then it's going to also provide some exceptional buy the dip opportunities on the market. So what am I doing in preparation of the market continuing to slide? Well, I'm starting to put together what stocks do I want to buy when the market starts shaking everyone out and it looks like it's time to buy the dip. Am I going to buy SPY? Am I going to buy Apple? Am I going to buy Walmart? Am I going to buy Shopify? Am I going to buy Alibaba? What companies am I going to buy? So that's what I'm doing personally to prepare myself for if the market goes lower, of what I potentially could pick up at cheaper prices, because that will allow the next few years better gain potential because we're getting things at a cheaper rate. So Fed Jay Powell said, hey, we're going to make things a lot more difficult in the short term for the long-term potential of resetting our government, resetting our economy, getting it back on the right foot bringing down inflation, and we potentially could create a longer runway for ourselves over the next 5-10 years by attacking this hard now and causing a very rough next few months. So with that, the Fed says we still have tools that we are going to utilize. Once again, higher interest rates and quantitative tightening are a great way for this to do so. So as of now, Fed J. Powell is saying, hey, prepare for weakness in the market. And the market reacted very, very aggressively to that and resulted in a 3.5% move down. And actually overnight at the current moment, the market has gapped down another 0.8. Okay, so we're down 4% as a whole in 2 days. All because Fed J. Powell said expect more pain to come before things get better. So that's where we're at. That's why the market ended up pulling back 3.5% all in one single day. I hope this helps you understand what's going on with Jackson Hole, why this caused a big impact in the market, and how to prepare for what's to come in the near future. I think there will be opportunities for buy the dip, but at this time, Jay Powell is giving us the caution, the warning to say, hey, we might have to inflict some more pain into the market before things actually reverse for good. So the things I'm going to be watching, keep an eye on inflation, see if it's come down at all. See what they're going to do with the Fed interest rates, if they're going to continue to increase those or not. And then keep an eye on oil and gas, commodities, and other things like that, which are inflationary type of assets. When those are increasing, obviously inflation is not necessarily declining, okay? Those are inflationary type of assets. When those are climbing, inflation's starting to tick back up or stay stagnant and not crash in the way that the Fed is going for. So I hope this helps you understand what happened with Jackson Hole, why it was such a nasty day on Friday, and I hope this prepares you for what's to come in the near future. Now, I have no idea where the bottom on the market's going to be. It could be tomorrow. It could be in a month. It could be in a year. I have no idea. But what I can tell you is Jay Powell is warning you that things could get worse before they get better. Okay? So that's where I'm going to leave you for now. I will let you know. I'm going to pull up a seasonality chart real quick. And this seasonality chart tells us that things could get worse before they get better, just as I mentioned previously. So here we are right at the end of August, and you can see over the next few months, we result in a big decline on the market for a second-year new Democratic president. It results in almost a 5 to 6% drop in these next 3 months. So with what Fed J. Powell is saying and what seasonality is showing us, I am telling you, be a little careful with a bunch of longs at the current moment, because right now, seasonality is against us, and Fed J. Powell's given us some insight at what might be to come, and this is based on data from 1946. So like I said, I hope this helps you, give you some clarity on what's to come in the market. Once again, I don't know how long this takes, but based on seasonality, it could be through the end of October. So please go ahead, like this video, subscribe, comment on it. It's greatly, greatly appreciative as we are starting off the YouTube grind. So if you appreciate these videos, please let me know. I'll be happy to make more videos in the future. If you want to see a specific type of video, go ahead and leave that in the comments below, and I'll take a look at those and potentially make that happen for you. So I hope you have a great night. Thank you so much for stopping by the channel, and I'll talk to you very soon.